Welcome back to Rockstock Channel. It is Wednesday, April 23rd, and we're here with Caspar Rawles, the Chief Operating Officer of Benchmark Minerals Intelligence, with breaking news that Benchmark has signed a major agreement with the Intercontinental Exchange to develop futures contracts for lithium, cobalt, and other critical minerals. The new futures contracts will be settled against BMI's price assessments and represents the first time the Intercontinental Exchange has moved into mining. They are the world's dominant exchange in energy trading, especially oil, natural gas, and electricity, as well as environmental products. But this is the first time that they're getting into minerals. Uh, the first phase of the partnership will have four key cash settled futures contracts. One is for lithium carbonate, CIF Asia. A second is lithium hydroxide, CIF Asia, and also a spodumene concentrate, FOB Australia, as well as a cobalt hydroxide, CIF Asia contract. So Caspar, Rodney is our derivatives expert, so he'll be asking more questions, but you have in the press release here a question. What does the ICE BMI partnership bring to the lithium and critical minerals industry, considering, we already have, I guess, the CME, LME, hydroxide futures, the GFEX, et cetera.
Yeah, thank you, Howard. Yeah, as you say, we already have some options for contracts that are out there on futures exchanges. I think, the market is still, well, as we all know, right, the market is still very immature and it's still going through a significant growth phase. And I think, there's lots of change that is still yet to happen. I mean, first of all, from the GFX side of things, as you know, quite correctly, it is a liquid contract. But what we've seen is that many kind of Western supply chain participants aren't keen to use the Chinese exchange to hedge their exposure, particularly US companies, but kind of more broadly outside of the US as well. So whilst that is currently a liquid contract and we're seeing, that grow over time, what we see is that, as I say, those companies in the supply chain who are not based in China, may not even have the ability to trade a Chinese contract, but B, also don't want to, particularly when we consider kind of the political environment and the ramping trade war that we're currently watching all from social media. So in many cases, that's not a suitable option. There are other futures contracts out there which have historically not been that liquid, haven't always necessarily been an option. But what we've seen at Benchmark or BMI, as we're being listed on ICE, which you'll see from the announcement, is primarily the exchanges have come to us to launch these contracts with us. And what we've seen is, as Benchmark has been set up with lithium at its core, it was set up from the outset to focus on the energy transition. Very much the exchanges appreciate our methodologies, which are centered around an expert analytical approach rather than legacy kind of commodity media, which has been the approach in the past for a number of different PRAs. So I think, our data is, very well respected globally. We're seen as a market leader in terms of price data, and having that on the exchange is very beneficial, particularly where we see we're indexed in a large number of supply chain contracts.
Okay, thanks for that, Casper. Just before Rodney gets to the questions, I forgot to mention at the opening, Benchmark's going to be having a formal webinar to discuss this. That will be on April 30th at 1 p.m. BST. What is BST? Is that the Greenwich Mean Time or what?
British summertime.
British
Brit-
summertime.
Yeah.
So that's 5 hours ahead of Eastern time. So we'll put a link in the description to that webinar in the show notes here. But just feel free to tune in April 30th.
Right. So, Caspar, just following on what you said there, is it fair to say that there are a number of contracts out there in the market for commercial transactions that are linked to benchmark data? So is this going to be a sort of improved correlation between what people are executing in the real physical lithium market and how they can hedge it.
Yeah, exactly. Yeah. So, we've always, as a business, very much focused on the physical world. So that's, yeah, physical tonnage transacting between producer and consumer, and pricing the prevailing transaction price in that market. So our price assessments very much focus on where things traded rather than kind of bids and offers. And we've seen that we've gained a lot of traction throughout the industry since we launched because of that kind of focus on quality of data and accuracy. And so our pricing has been used, for some time now by the industry to settle supply chain contracts. So, I mean, I'm sure the vast majority of people who are listening to this will know, but for those that don't, um, in terms of kind of long-term supply chain contracts, so what, multi-year or even 12-month contracts, rather than negotiating price on a monthly basis, both counterparties agree to use an independent price written into their contracts. Then that determines what the monthly shipments will be priced at and what the contract will settle at. And our prices, particularly around lithium, are used to do that. And the idea being that if you're for example, and I'm not naming any names here, but if you're a large automaker or a company in the supply chain that's consuming large amounts of lithium, you have a long-term extended exposure to the price, the benchmark price. So the launch of these contracts, what it enables you to do is to therefore hedge some of that exposure. Whether, as I say, it could be any duration of time. Obviously, liquidity will build for the longer maturations, but effectively expose your price risk in the physical, reduce your price risk exposure in the physical world by using these futures contracts to manage volatility. And as you know, I mean, maybe not right now, not for a while, but we've seen very high volatility in the lithium market in particular over the last few years. So that's a major concern for companies in the supply chain who need to sell products at certain prices or certain price points, and this enables them to help manage some of that risk and exposure.
And Caspar, the next logical question following from that is, how far out are these contracts going to go?
Yeah, that's to be determined. I mean, typically you don't want to put very long duration contracts out there immediately, just because you're looking to build liquidity, and that generally comes in the front end. If we think about mature markets, you can have contracts out that are out there 5 years or more. I think initially, and don't hold me to this. This is just my feeling. This is not any like prior information. I think it makes sense to have something probably up to about 2 years. A lot of supply chain contracts are kind of 12 months, or well, let's say pricing term could be renegotiated every 12 months. But having something a bit longer is probably beneficial. We would really like to, though, as I say, like the goal is to get to much longer terms because the example I previously gave in terms of how someone would want to hedge risk is people buying and selling the physical, but also when we think about the requirement for financing in the supply chain. So as we know, big deficits looming. We need to i- increase the rate at which we're building mines. I did some analysis on this for a presentation recently, and looking at the previous 10 years and the next 10 years in terms of how much lithium production we need to bring online. When you compare what we did in the last 10 years to the forward-facing 10 years, we need to work about 4 times more quickly than we have in the past. So we need to bring on 4 times as many mines in the next 10 years as we did in the last 10 years. So a lot of that is going to be greenfield operations rather than expansions. And there's a need to finance. And in many cases, the banks that are loaning money to developers or mining companies looking to build those new mines would like them to hedge some of that exposure of their production, so that they can ensure that they retain profitability in low price environments. So we may also see that the banks get involved on that basis. And generally speaking, obviously, you're looking at much longer term investments and much longer durations that you need for the contract. So we very much would like to get to a place as quickly as possible to see some liquidity out in the longer term as well.
And then that rolls into my next question. So, having looked at transactions and other commodities in my past life, in the end, the question then will become, how is the credit risk going to be managed in these contracts? Is it likely to be the banks that actually take on the project risk and then do the executing on the exchange so that it's their credit risk in terms of being able to settle, or if there's something happens on the physical. So how does it look from a structure perspective of who the clearing members are, and how, who gets vetted and how that works?
Yeah, so ICE has its own clearing house, or it has a number of clearing houses, but for the purpose of these contracts, it will be the European Clearing House. ICE Clear Europe, I believe, is the correct name. Sorry if that's not quite correct. But they have a number of clearing members, which are typically banks. Now, I'm not an expert on credit and how credit will function between the different counterparties, but generally speaking, what you'll see for the majority of companies in the supply chain is that they will execute hedge via their bank. And the bank may be a clearing member, it may not be a clearing member, it may then have to go via a clearing member to do that. But typically what that means is that the credit risk or the agreement is not between the company in the supply chain and the exchange. It's between a bank and the company in the supply chain, and then the bank warehouses that risk, as many banks do, and then they execute on the exchange for them. And that may come from a number of different avenues. So there may be companies in the supply chain who just want to hedge risk, and they go to a bank to do that or their finance department will, because they don't want to do it themselves. There's some very big companies that are active in the supply chain now that may just do it directly themselves. They may have a trading entity and may have the ability to do that, particularly when we think about, as we're starting to see more and more energy companies come into the lithium world. Many of those already have trading entities, and they already trade on ICE, because ICE is a very big oil and gas exchange. And then you may also have scenarios where banks require some of these companies in the supply chain to hedge some exposure to reduce risk. So there's lots of different areas it will come from, but primarily the trading will happen by and large by financial institutions rather than companies directly accessing the exchange.
Okay, great. And then I'm assuming ICE will be setting the initial margins and those kind of things for the contracts.
They will, yeah. So that will all be made clear ahead of the launch, or when trading commences. And they will, yeah, that's all very much structured within kind of rule books and regulations of exactly how that works. So that will all be clear. And that's, to be completely transparent, and that's nothing to do with us at all. That's all completely controlled by the exchange. We provide the price data which settle the contract, but those kind of terms are very much dealt with by ICE and not by us.
And Caspar, what's the timeline looking like on this?
Yeah, I don't know if I can say that publicly, but later this year, definitely. In the not too distant future, I don't actually know if I can say, but I can maybe come back to you and give you an update on that. But yeah, it will be some
The
stage this
target
year.
is some stage in 2025 before year-end to be up and running.
Yeah, for sure. To be able to actively trade, yeah.
Okay, great.
Caspar, I have a comment and a question. You're having a spodumene concentrate futures contract. I don't believe that such a contract exists on the. I remember in 2019, 2018, when there was all this talk about the LME getting into it, and it was going to be hydroxide versus carbonate, and I was arguing, the greater volume of activity, and maybe like the iron ore futures, why not do spodumene? But maybe SMM has some spodumene, but I think that could be a real differentiator, because we've talked to kind of like Goldman Sachs and Macquarie, and there are some like over-the-counter derivatives kind of tied to the CME hydroxide contract for spodumene developers. But this one, I think, could be a real differentiated contract. So can you comment on that?
Yeah, absolutely. I mean, yeah, we see, as you say, well, people are exposed to spodumene prices in their long-term supply contracts. So obviously, it really depends on who you are, what you're buying, what product you're tying your pricing to. But in many cases, we're starting to see, particularly the kind of downstream of the supply chain, so automakers now take on more and more of the raw material responsibility, And there's always a goal to reduce costs, as you would expect. So one way of being able to do that is to procure spodumene rather than finished lithium chemicals and have that told yourself. And, you can manage your costs, or your control your costs, hopefully better than if you're just kind of acquiring via your cell manufacturer or lithium chemicals directly, whatever it may be. So having the ability to be able to do that is, to hedge to spodumene prices is a big deal. You can also start to think about where you have an exposure to one or the other, or you think you have a view of like what spodumene prices will do versus chemicals. So you can start to get involved in kind of trading between the differentials between the two, as they're called. So it's very useful, and again, we've seen, as you both very well know, spodumene grow very quickly to be the dominant source of material or feed for the lithium market. And of course, that is still expected to grow. And we are seeing, historically, we've seen that supply be able to come online a bit more quickly, and also has, largely speaking, well, maybe not largely, but has been coming from developers who are going to be more dependent on financing from banks rather than existing producers who are expanding or, launching new operations, and in some cases can do it off their own balance sheet. So, um, having that ability to hedge the spodumene price, as I say, we are present in those contracts and people are referencing that price as well as lithium chemicals, is a big benefit to the industry, and will be interesting to see how the liquidity grows there.
Great. And the comment just, so this ICE, which I mentioned, is kind of oil and gas, electricity, and environmental. And the first mine contract, this is kind of like energy transition. It's an electricity metal, right? Lithium, the dominant kind of derivatives, of that. I think that's very interesting from ICE's perspective, that they're not launching nickel, they're not launching copper. I guess they are launching cobalt. But with you. But anyway, that's very interesting. I know Piedmont and Sayona have been among the more active users of the hydroxide um, contract. They have mentioned to us that they've managed, and that has gotten some liquidity, I think, 2 years. So I think, again, I think this could be like a really active contract. And if it could go 2 years, 3 years, I guess we'll just see what the activity is. But looking forward to it. And just a reminder again, May 1st, in 8 days, is this webinar at 1 p.m. UK time. That's 8 a.m. Eastern time. And I'll just flag as well, I'll be at the Benchmark Giga USA conference on June 2nd and 3rd. I think that's Tuesday and Wednesday in Washington, D.C. And I think it'll be a pretty boring conference because there hasn't been much happening in D.C. lately as it pertains to our industry. So anyway, if you'd like to meet me, come there and say hello. But absolutely, I've been to many of these, and no doubt it's one of the most important conferences on the lithium and battery materials circuit, this Giga USA in Washington. Anyway, thank you, Caspar, for reaching out, and congratulations on this awesome, another important milestone in Benchmark's evolution.
Thanks, Howard. Yeah, I appreciate you having me on the show.